Hi everybody, hope you well, hope you're fantastic. My name is Gavin Mkabela and welcome to my YouTube channel, Gav Talks Property and Finances. Please don't forget to subscribe to the channel by clicking on that red button below so that you can be notified whenever I load new content. But just to give you insight in terms of who I am and what do I do, I'm the founder and the managing director of a company called Gavin International. We are an unconventional property investment company that fuses real estate, financial planning, and mental health awareness. Yes, I know we sound very unconventional, but if you want to learn more about exactly what we do, please visit our website on www.gavshaw.co.za. So www.gavshaw.co.za. But back to the business of the day. Now, today's video, I wanted to touch on, the structural aspect of investing in property, right? So which entity do we use and when do you use it, when building your property investment portfolio? But before I get to the structural aspect of things, I wanted to touch on, this most important part. When you are investing in property, there's two sides to property investing that you should know, right? You might be already investing, but you might not necessarily know that, there's two components when it comes to property investing. Now, one is the short-term side of investing in property. So a lot of the times people can come and say, Gavin, I want to get into the property investment game, but I don't necessarily want to have a portfolio, right? So, but I want to make money out of property. So, I want to make money as quickly as possible. And that alternative can be the short-term side of it, where we now look at buy and sell. So meaning that you are buying below market value and you're selling then at the profit and you're making your money as quickly as possible. But of course, the idea there is not to hold the property. It's not to have multiple properties that are generating income, which is where now the long-term side of investing, will entail, because there you are looking at building a portfolio. So you're looking at having now these properties that will then be generating this income for you on a monthly basis, right? But why would you want to do that? Now, there's a number of reasons when it comes to, now somebody investing in property for the long term. And that's exactly what we're really going to concentrate on with regards to this video. But let's look at some of the, the reasons why one would look at, investing in property for the longest of term. Number one, it might be that you want to supplement your income, right? So you want to supplement your income. So this could be your salary, this could be money that you're getting in from your business, whatever the case might be. But you might be looking at supplementing your income, because we're realizing now that it's tough, guys, right? Financially, it's really, really tough. So most of the time, just having one salary is not enough. So it means that you need to have, multiple income streams that can definitely assist you with regards to your expenses and just in overall living, from that perspective. But of course, with regards to, flipping, you could do that, when you buy and sell, from the short-term side of it, that can also help you with regards to this as well, right? And even other, stuff that I'm going to be mentioning now. So, but we start with supplementing your income. Sitting there, I want to supplement my income, and property might be one of them. And the beauty about property is that, technically, if you do it right, you don't have to, you don't have to do much on a monthly basis, especially if now you have somebody that will be looking after the property, like a rental agent that will be managing all of the stuff around the tenant. You don't have to do, much on that. All you do is just you collect the rental on a monthly basis. But yeah, number one, supplement your income. Number two, it might be that you want to leave a legacy for your children or your family, right? So you want to leave a legacy for your family or your children. So when you pass away, you want to make sure that at the end of the day, your children or your family will be taken care of. So on a monthly basis, they'll still be getting this income coming from these properties. And that's the beauty about properties, guys, that, even if I'm no more, right, my kids can still benefit from that rental income forever. So that's the beauty about it, right? So the legacy aspect then also becomes a key thing when it comes to now, especially looking at the long-term side of investing in property. The other one could be retirement. All right. So we know that a lot of us, are in trouble. A lot of us are in trouble, and the reason is, different reasons. But it might be that our retirement saving is not adequate. We see that we're gonna be in danger, when it comes to retirement. We might not retire comfortably. So meaning that when you get to that stage of retirement, you might find yourself in trouble, which is where we don't want to get into. We don't want to get to, right? Because if now we give, we have to give it like, statistics when it comes to, especially in South Africa. I mean, it's there that, 6% of people in South Africa retire comfortably. Imagine only 6% of people retire comfortably in South Africa. Like, imagine that, right? So what happens to the other, 94? It's a big thing. So property might also be a way out, to help you with regards to that. And I always say that as long as you have a tenant, you'll forever have income. And that's the beauty, right? And then the other one could be, or the last one could be, you want financial freedom. All right, excuse my writing. But you want financial freedom, okay? So you want to make sure that you can buy your time. You can buy your freedom, if I have to put it that way. But think about it. If you can, today, in terms of your income that you make, let's say at work or via your business, let's just put this into context. If you had a portfolio that can give you, what you are earning right now, or even more, right? How beautiful would that be? Because at the end of the day, if I don't want to work, I don't have to work, right? I can go and do whatever that I want to do. Because we all know there's some people that hate their jobs right now, but you need to work, because there are bills. You need to be able to have income in order for you to be able to survive. But imagine if you got the money that you're getting now, or even more, without doing much, wouldn't that be great? It will buy your time, right? I know that you want to do photography, but you can't do that because you are always at work. You need to report at 8 o'clock. You need to be there reporting until 5 o'clock, and we know all of that stuff. But that's some of the things that can help you when it comes to property. All right. But now let's go into the long-term side. But as I said, this can also feed into the short-term side of things, right? So it can then assist you. Like I always say that, when it comes to investing in property, you don't have to do one thing. You can do both, right? So you can do the long-term side of things, and you can do the short-term part of it, because you can basically use the short-term to raise money, raise capital that can help you to then build on your long-term strategy with regards to your property investment portfolio. But now let's look at the entities, because I think this is where now we get confused to say which one do I use when, right? Now there are three main entities that you can use to buy investment property. You can use your natural estate, right? Or you can use a private company, or you can use a trust, right? So you can use these three entities to buy investment property, right? But you might be asking, so Gavin, let's start with the short-term side of the coin. So when I look at the short-term side, which one can I use between the three? Or which one should I use between the three, right? Look, at the end of the day, it depends on your personal circumstance, right? Which is very, very key. But I normally advise, say, look, because it's the short-term side of things, you want to get in, get out, right? Maybe the natural state might be the easiest thing to do, because we also look at issues such as capital gains tax. Because remember now, if you're going to be buying low and selling high, the revenue, the tax revenue or the tax man sees that as an appreciation, so they might tax you there, right? So those are some of the things that you might look at. But of course, from an income perspective, you might not necessarily get an income, so you might not then be charged on the income because there's no income. You are in, out. But in terms of now capital gains tax, it might be something that you now need to look into. And that's the beauty about what we do, because we do have the accounting side of the business and have tax specialists that can help you with regards to that, right? So those are some of the things that you can look into. But I generally would maybe look at natural, but there's somebody that can say, look, you can buy in a company, or you can do that in a trust. But as I said, if you look at the private company, you look at the trust, maybe the capital gains tax might be higher there. So that's some of the things that you might look into when it comes to that. All right. But back to now to say, all right, cool. We are in the long-term side of it. We want to understand. So I want to build a legacy. I want to make sure that at the end of the day, I attain financial freedom. I want to make sure that I supplement my income. So now I'm buying these properties. I'm building my portfolio so that I can be able to extract the rental income that comes with that. Cool. So now there are 3 things that we need to be aware of that becomes very, very, very important. That normally would guide us in terms of the entity that we can use, right? So number 1 is the issue of tax. All right. Number 2, it is the issue of creditors. And then number 3, it is the issue of our personal estate. All right. So tax, creditors, personal estate. So normally those 3 things guide us when we now building for the long term. All right. So let's start with the natural state. What does, from a tax point of view, what does it mean when I buy these properties in my name? Remember now that there's going to be an income that comes in from the tenant, right? So I have an income that I'm generating there. So from a tax point of view in South Africa, we now deal with a progressive tax system. So the more I earn, the more tax I get, right? So I might have a salary at work. So there is a taxable income that I get from my employer. So whether I like it or not, they're going to tax me. That's the unfortunate part, right? So whether I like it or not, I'm going to be taxed. And depending on my salary bracket, it's going to move from 18% to 45%. Right? So our tax system, it moves from 18 to 45%. So depending on how much you get paid at work, then it will determine your tax rate that you are charged by the taxman. Right? So that is now sitting in my natural state. So 18 to 45%. So you can now be earning some okay salary, but now you might have a big portfolio when it comes to your property, meaning that your taxable income is gonna grow. Because remember now, SARS looks at the money that you're getting from the tenants, especially if now you're hitting the profit mark, then they look at that and then they combine it and it increases now your tax rate. So it's something that you should look out for, right? So that's in your natural state. But now let's come to the private company now. What does tax, where does this fit in from a tax point of view? Now, when it comes to the private company, the tax rate there is 27%. So it's 27%, right? Flat 27%. But of course, you can also do offsetting even here, but more in the private company, you can do your offsetting. So meaning that you can offset a lot of expenses, which now when you offset a lot of expenses from your income, from your rental income, it reduces your income, and that subsequently reduces the amount of tax that you pay on at the end of the day, right? So those are some of the things that we'll cover, when it comes to tax. But for today, we're just looking at the structure, right? And then now from a trust point of view, the tax rate there is 45%, right? So it's 45%, and that is why I feel that I hear a lot of people say, "Your tax is very, very high in a trust." Yes, of course, it's very high. It's 45%, right? So that might be the issue as well. Cool. So now we've covered the tax part. So in your natural state, moves from 18% to 45%. In a private company, it's 27%. In a trust, it's 45%. All right. Now let's come to creditors. Now, what does it mean to buy in my natural state when it comes to my creditors, right? So when it comes to my natural state, when I buy these properties in my name, so when I get to the stage where now they're fully paid up, that might be a problem as well in terms of, they might be vulnerable. So if now I have creditors that are coming after me, they might look at those as an asset, and they might then want to attach them, so if I'm in trouble. So those are some of the things that you look at to say, okay, is it the benefit of me buying in my personal estate, especially when it comes to creditors? Because things happen, guys. You might not have a creditor now, but you might have tomorrow. So those are the things that you definitely need to look at from that perspective. So creditors, we need to look at from a natural state. So remember, if I have a creditor, I've signed that agreement in my personal capacity. So they will come after me in my personal capacity. So if whatever assets that I have, they're true assets, they might attach them. Okay, so that's natural state. And then the private company. So private company from a creditor perspective. So whatever that agreement that is here, it becomes very difficult now for that creditor to come after the assets that now belong to my company, right? So that as well might help you to cushion or to protect those assets in that part, or protect those properties. Because again, if there's an agreement between Gavin and Joe, it's exactly between in our natural state. So it's not between Joe and Gav Shaw, right? So there's a distinction there. And then let's come now to the personal estate. So personal estate is where now looking at my personal things, the assets and liabilities and everything else. So when it comes to my personal estate, especially now when it comes to, two sides, there's two main sides that you definitely want to interrogate when you are talking about your personal estate. Number one, it will be divorce, right? Especially if now you are married in community of property. So what does that mean? When I divorce, it means that obviously the other spouse will then be entitled to the 50% of my things, of my properties. So you need to look at that, right? And then of course the second one is death, right? So when I pass away, what happens to my assets? What happens to my properties? I always say that you always need to take yourself as an entity that you are. So meaning that this entity, when I pass away, so when Gavin passes on, the entity that is Gavin ceases to exist. So meaning that Gavin will be no more. So whatever Gavin owns cannot stay under Gavin's name, right? Cannot stay under this entity because it's no more. So it now needs to be transferred to somebody else. It might be transferred to my beneficiaries, whether it's my kids, my spouse, whoever, right? But it now needs to move. So when now it's moving, when it now needs to move, there are cost implications to that, which we always need to be mindful of, right? So let me then touch in terms of the cost aspect when it now especially comes to death. So when I pass away, what are the three main costs that we normally look at, when it comes to your personal estate? So number one, we look at the estate duty. Estate duty. All right. That's what we look at, number one. Number two, we look at executors' fees. Executors' fees. Fees. All right. And then number three, we look at possible capital gains tax. Okay, excuse my writing, guys, for today. It's very cold. Eh? So we look at estate duty, number one. We look at executors' fees, and then we look at possible capital gains tax. So let's start with estate duty. So estate duty, the taxman wants money. We need money as a country, fix roads and all those kind of things. So now the taxman says, if you have assets within your estate that are above 3.5 million. So now I'm speaking from the context of South Africa. I know that you might be somewhere else in the world. So I think it will be great just to find out exactly within your country what will then be the tax implication when it comes to estate duty, right? So in South Africa, we are now, SARS, which is our revenue service, they charge us 3.5, they charge us 20% on anything that is above 3.5 million. So let's say if my assets in the state are more than 3.5 million. So more than 3.5 million. So anything that is above that 3.5 million threshold, it's going to be taxed at 20%. So 20% will now be taxed, on anything that is above 3.5 million. Can be a lot of money, right? Could be a lot of money. So anything that is 3.5 and below, it's exempted from this 20%. So that's the first part, right? Then there are executors' fees. So executors' fees, this is now where we talk about the person that has your will, or the institution that has your will. So actually, let's put it an institution. So the institution that has your will, right? And then again, depending on what agreement you have, what things are in place when it comes to that will. But we know that most of the time they say the will is free. Yeah, it's free now while you're still alive. But when you pass on, your estate will need to then pay for that, right? So now it can go up to 4.025%. So it can go up to, so I want to emphasize this thing, it can go up to 4.025%. So let's include the VAT there. Why I say up to? Because you can negotiate your executors' fees. You can negotiate them, right? A lot of people don't know, but you can negotiate this fee at the end of the day. All right. So, because think about it, you don't think that attorneys and everybody else, the bank does this for free. No, they want to make money out of that, and a lot of the times they'll make money when you are no longer there, through your personal estate. Okay. So we need to understand that 4.025% that will now go to the executor. And I want to now highlight that this 4.025% gets charged on the gross value of your estate. So it's not only just charged on the assets, they charge it combined on your assets and liabilities. They look at that and say, what is the gross value of your estate? And then they charge it on that. So please make sure, guys, again, the entire video is all really about that you should go and consult professionals. If you don't know what to do, reach out. We do have all these professionals in house that's going to help you, because a lot of the times we do these things without knowing, and we find ourselves in trouble, or the people that are left behind are now in trouble, right? So please make sure that you consult. Very, very important, right? And make use of that free consultation. It will definitely assist you. Then the last one is possible capital gains tax. So what is this? So now in terms of, because again, going back to the entity that is Gavin, the entity that is going to pass away, and now my properties now need to move from my name, and they need to go into my children's name or my spouse's name, right? So when now they move, right? So it's basically like now you are selling those properties to somebody else. Yeah, because remember, I'm a different entity to you, or then selling it to maybe a company or a trust, right? So it's now it's looked at as you selling it. So now it's not gonna move from my name to somebody else's name, based on the price that I bought it for. No, it's gonna then move at the current market value. Right? So it's going to move at the current market value. So now they're going to look at that and say, so the receiver is going to say, so the current market value of this property is 10 million. But Gavin bought it at 1 million 10 years ago. So it has appreciated by 9 million. So meaning that 9 million is now will be subjected to capital gains tax, right? Because it has increased in value. And capital gains tax can move anything between 13 to 18%. All right, so it can move anything from 13 to 18% based on your tax rate. So again, if you are outside South Africa and you're somewhere else, please make sure that you familiarize yourself with regards to the tax regime within your country, which is very, very important. So I'm speaking from a context of South Africa. So these are the things that now you need to be mindful of as you build for the long term, because again, SARS and the executor are what we call preferred creditors when it comes to winding up the estate, meaning that they get paid first before anybody gets paid. So please make sure that you understand all of that, right? So now we have dealt with the natural estate. Now let's look at the private company. So private company creditors, as we touched it, it protects you from that basis. But when it comes to your personal estate, so your shareholding here will still form part of your personal estate. So if now I have properties worth 10 million in this private company, that 10 million will form part of my personal estate. All right, so you should be mindful of that. So I do have the benefit of the tax from a 27%. When we look at obviously the 3, you have 45, and here it can go up to 45. So I do have the benefit of the tax at 27%, but we need to be mindful of the fact that the shareholding will still form part of your personal estate. All right, cool. So now let's look at the trust. So where does now the trust come in? So the trust, we now have established that the tax is very high at 45%, right? Just the same as the natural estate, which you can get up to 45%. So the tax then becomes a bit of a challenge, right? When it comes to creditors though, where are we with the trust? We have now independency. So one of the great things about the trust is that it creates independency between you and the trust. So you are not the trust, you control the trust, right? So whatever that is owned under the trust, it is you don't have that ownership. So you have the control of it. So the trust has its own independent, separate identity from you. And that's the beauty about it. And that is why you see a lot of people that are intentional about building wealth, a lot of them will forever have a trust. Why? Because it creates that independence. Because again, we know that things happen. You have creditors that are coming after you. Maybe you get into marriage, you made in communal property, but you have assets that you want to protect. So some of these, some of these things are helped, are protected by the trust. So that's very, very important. But I also want to cover this. It's always very important to understand there are two main trusts that we talk about. We have the testamentary trust, and then we have the inter vivos trust. And then here we are talking about the inter vivos trust. So this is the entity that now helps you to house your assets. So that is the inter vivos trust. Then there is the testamentary trust, which now is attached to your will. So this is the one that says, when I pass away, what happens to my financial affairs? Right? Maybe I need to then nominate my mother, I need to nominate my spouse, I need to nominate my brother, I even need to nominate an institution that can then basically administer my finances on behalf of my children, because maybe they're not old enough to do that for themselves. So that can use a testament trust to do that. So it's always very, very important to distinguish between the two, the testamentary trust and the inter vivos trust. Here we are talking about the inter vivos trust. All right. So now these are the three entities that we now normally use. All right. But there is a fourth one. Okay. It's not an entity, but it's a combination of two. Right. So this is where, because at times somebody can say, but Gavin, I don't necessarily now want to buy in my natural estate because I'm going to now hit the 45% and there is the vulnerability around my estate and the creditors. Right. So, but I'm looking at the company now. I love the tax aspect of things, but it still forms part of my personal estate, which I don't necessarily like. So again, with the trust, I love the independency, but the tax part of things becomes an issue for me. So is there another alternative? Yes, there is another alternative. This is where now you combine the private company and the trust. So you combine it, right? So how do you combine it? Is where now the trust becomes 100% shareholder in this private company, in this PTY. So the trust owns the company 100%. Okay, so now when you do that, you're going to be the director of this private company, and then you are going to be the trustee in the trust, and then your kids will be beneficiaries. Okay, so at the end of the day, you benefit from the tax in the private company, because everything is going to take place in the private company. So your rental income, your offer to purchase, you sign in the private company. So everything happens here from a transactional point of view, but from a protection point of view, everything lies in the trust. And remember, I said there's a total independency when it comes to you and the trust. So you know that at the end of the day, my assets, these properties are protected, but I still have the benefit of the tax within this company, right? So you have these two entities running concurrently, right? But you might be asking and say, but Gavin, from a tax point of view now, does it mean that I'm going to be taxed twice? No, you're not going to be taxed twice, because everything happens here. So if you want to draw income from the company, you basically will be, you pay yourself a salary, director's drawings, whatever the case might be. And that's why, having that accountant, somebody that can help you to basically then maneuver around it. But you have then the benefit here. So nothing from an income perspective will flow into the trust, because if now it flows here, normally it will be you paying the shareholder a dividend. So now why would you do that? Because then it will be double taxation at the end of the day. So you see the beauty about that. So you run everything in the PTY, and then the trust basically then protects everything else from that point on. So that's the beauty about now using these structures, so that at the end of the day, you can then be protected. But every single one of them, the entities, have a role to play, because as I said, we all have different circumstances, and it's always very, very important to understand your circumstance, get help, get assistance, so that whatever that you're doing, that portfolio can be tailor-made according to your needs, because not everybody has children, not everybody has dependents. Maybe then the trust doesn't become very, very important, right? So that is why I say rather have get help, so that you know exactly what to do. But I hope that this will definitely assist you in some way. There's still more, but I feel that because of the sake of time, I can't go through everything. But I feel that this will definitely assist you. And then, as I said, if it still sounds and feels like a jargon, please reach out to us. Send us an email on info@gavshaw.co.za, or you can send us a WhatsApp on 074-412-7614, or just go to our website www.gavshaw.co.za. Get everything else there, and then please don't forget to subscribe, so that you can be able to help us grow the channel. And please share as much as you can with the people that you know, that you love, so that they can know, they can benefit from all of this as well. So, but anyway, from the bottom of my heart, thank you so much for staying up until the end, just consuming all of this. I truly, truly appreciate it, and I appreciate your time as well. And have an amazing and incredible day.